Good evening, ladies and gentlemen. This is Barry Norman on behalf of Trade12 at investing.com, and welcome to our class on leverage. Today's class is sponsored by Trade12, one of the world's leading providers of online trading. And tonight we're going to be learning about how to use leverage and margin, or how to understand what it's all about, because a lot of people get confused and misunderstand exactly what it is. Now, Warren Buffett is a proponent of leverage, and he's got some warning though for the marketplace, because he says when leverage works, it magnifies your gains. Your spouse thinks you're clever and your neighbors get envious, explained Buffett in his 2010 shareholder letter. But leverage is addictive. Once having profited from his wonders, very few people retreat to more conservative practices. And that is one of the biggest problems with leverage, is it is addictive. And traders just keep getting higher and higher, or claiming higher and higher leverage, until not only do they lose what their gains or their profits, they end up losing their portfolio. It's very easy to get sucked in the game. And if you've noticed, very recently, we've had lots of the regulators around the world cutting back what can be offered in leverage to help protect the traders from getting in over their heads. Now, even though Buffett was primarily discussing leverage in relationship to personal debt, because it's almost like credit card debt. You know, your credit card companies keep giving you bigger, higher levels of debt, and you keep spending. Before you know it, you get farther and farther in. Now, leveraged CFDs are like regular trading laced with greed and impatience. They attempt to deliver multiples of performance of an underlying index or benchmark they track. Some trade broad indices, while others trade specific sectors or commodity. Leveraged CFDs seek to magnify returns by using some of Wall Street's favorite financial drugs: derivatives, future contracts, and swaps. Now, this is just a forewarning, because leverage is a great tool if you know how to use it, understand it, and use it wisely. Now, leverage is a facility that enables you to gain a larger exposure to a financial market while only tying up a relatively small amount of your capital. It is a key feature in CFD trading. When you invest in leveraged products, the provider will ask you to put up a sum representing just a fraction of the total value of your position. Now, some people mistake this for like an insurance premium. Others mistake it for a deposit. It is really neither. It is just your guarantee. It doesn't cost you money. It's not a premium, and it's not insurance. Effectively, the provider is lending you the balance of your contract or your investment. Your profit and loss is based on the full position, however. So the amount you gain or lose might seem very high in relationship to the sum you invested. It could even be much greater than your initial outlay. Now, what leverage does, it actually uses just like a lever. It allows you to lever up your trading so that your profits are higher. Now, for instance, with CFD and financial spread trading, you only have to put down a small deposit. So in other words, if you wanted to trade 10,000 shares and those shares were selling at 260 pence, and your required deposit was 15%, your down payment would be £3,900 to tie up 10,000 pounds worth of, or 10,000 shares. Now, this would allow you to make the profit on those 10,000 shares, where in conventional dealing, you'd buy those 10,000 shares at 260p, and you'd have to put up 26,000 pounds, and your profit or your loss would be exactly the same. Now, a 10%, there's two words that go together here. It's margin and leverage. The margin is the actual cash you have to put down to get the leverage. A 10% margin means that for just $100, you can get the same exposure as a $1,000 investment. In other words, 10 times 100. This represents leverage of 10 times or 10 to 1, or 10% margin. So let's say you want to buy 1,000 shares of XYZ company. At the current price share of $1, this would cost you $1,000. Easy straight multiplication. Now, most of us have an account that has $1,000 in it. But if you buy that X, Y, and Z share and the margin moves 50 cents, you made what? Think about it. You bought 1,000 shares at $1 a share, and if it moved 50 cents, you did really well. You moved a 50% move, or you would have made $500. Well, share prices don't typically move in 50% range of what your investment was. So if that price had moved 5 cents in your favor, you would have made $5. You wouldn't have covered your commission and cost, and the risk would have been very high. But if you were able to use margin, and instead of tying up 1,000 shares, you tied up 10,000 shares, you would have been able to make a lot more profit. So let's say in this example, you buy 1,000 shares of XYZ company. At the current share price of $1, your cost would be $1,000. If the share price goes up 20 cents a share, you could sell out your position at 1,000 shares times $1.20 or $1,200, and you made $200 profit, or 20%. However, some providers will offer you a chance to buy X, Y, and Z shares using leverage. All you have to do is then put down a margin, a percent of the total value of the $1,000, and you retain the full exposure. So let's say the initial margin requirement is 10%. So you would pay 10% of the $1 times 1,000 shares, or $100. That's all you'd have to have available in your account to buy those shares. At the same share price rose from $1 to $120, same movement, you would still make the same profit, or $200, if you had bought the shares outright. Okay. You had made the same profit in both cases, but using leverage, you only had to put down $100 as margin instead of the full $1,000. Your return on investment is 100% as opposed to 20%. Why? Because you put down $100 and you made $100 profit. You made $200 profit less than $100, so your profit was 100%. Okay. Now, the same actions occurred, okay, but if you had that $1,000 in your account, you would have been able to tie up 10,000 shares, and you would have been able to make how much? $2,000. Okay. So a lot of us, in order to gain enough profits to cover the risk, and at the same time to cover the cost, the commissions, and the spreads, need to use leverage. Otherwise, if you have a small account, you could trade all day and never make any money. Or even if you have a sizable account, especially if you're trading in Forex that moves in pips 1,000 of a point, or even a CFD, it doesn't move that much, but you need to magnify your moves by more than you have. So your initial outlay is referred to as margin or deposit requirement. Again, it's not a premium. It's not money you are spending. It's not money that's being taken away from you. It's simply a deposit. Your provider will request this to cover or part cover any potential losses you may occur. The margin is always a fraction of what it would cost to buy the asset directly, but the exact size depends on various factors. A more liquid market and less volatile market will require a smaller margin, whereas a volatile margin may require a larger margin. So don't go under the assumption if you have $1,000 in your account and your broker offers 400 to 1 margin, that you automatically can trade $4,000, because every asset has a different margin requirement. Every market has a different one. Or if you remember right, when we were going into Brexit, or we were going to U.S. elections, the brokers increased margin requirements because the margin is simply a deposit to help cover the broker if the market moves against you, to make sure you have enough money to cover what the potential move could be. Some products require margin as a fixed amount per contract, while others are calculated as a percentage of the value of the position. Margin rates and slippage factors can vary dependent on the regulatory rules governing the country in which your account is based. Now, again, you've seen lots of headlines depending on where you are in the world on margin. Margin and leverage are always part of a regulated requirement. Okay? But the regulators for a long time let very high margin or very high leverage exist, especially in CFD and Forex trading, because online retail trading has grown so much that we get a lot more inexperienced, naive traders who lose more than they've invested or more than they can afford, and then want to call the regulators and complain. Okay. The regulators have determined that they need to rein in this margin, and they're slowly cutting back. So I don't know what the final outcomes are, but it looks like the UK is going to end up at 50 to 1 for experienced traders and 25 to 1 for new traders. I think it's going to end up in most of Europe about 25 to 1. Turkey just cut theirs back to 10 to 1. And this helps somewhat protect the trader, because what they're doing is, in essence, is they're making rules to protect you from making mistakes or getting in over your head. So in essence, what they're saying is alcohol is legal, but they're going to make the bartender control how much you can consume, because you can't hold your own consumption. So it's all changing very quickly. Its leverage isn't going away, and there'll be ways for more experienced or larger traders to get around, but the regulators are trying to protect the small investor from losses, only because it is an addictive feature that allows somebody to get in way over their head. Okay. Using leverage is a key advantage of CFD and Forex trading, but needs to be thoroughly understood to avoid potential pitfalls. To illustrate this, let's go through a detailed example showing share CFD trading using leverage. Now, share trading or equity trading or stock trading has a different leverage than a CFD share trading would be. Okay, and they are controlled by different requirements under the law, especially in the US. So let's say HSB shares are currently trading at 616 pounds, and you want to buy 1,000 shares. If you buy from a broker ignoring commission, you would pay 1,000 times 616 pounds, or 6,161 pounds. If you buy 1,000 shares of HSBC as a CFD, you will be able to leverage and put up only a fraction of the full value as an initial margin. For a major share like HSBC, the margin requirement may be as low as 5%. So to buy 1,000 shares as a CFD, you would pay 1,000 times 616 times 0.05, or your total investment or your total margin would be 308 pounds. If you were actually buying the shares, you might have to put down much more than that, or 100%. Now, despite this, both deals offer you the same exposure. If HSBC share prices go up or down, your profit and loss will be exactly the same regardless of whether you bought the shares outright or simply traded them as a CFD. So say HSBC drops to 582, same calculations as we saw in XYZ company. You can see that using leverage is a great way to magnify your exposure in a particular market. However, it should always be kept in mind that leverage not only magnifies your profits, but also your potential losses. It is possible to lose much more than your initial margin, not your initial investment, but your initial margin if the market turns sharply against you. Remember, margin is not a premium, and it is not an insurance policy. It's only a deposit. That's all that it is. So imagine you're buying a house and the guy says, I want a $1,000 deposit. It doesn't give you any insurance. It doesn't give you any value of the house. If the house goes through, before you pay for the house, you subtract the $1,000. If the deal gets canceled, you get back your $1,000. But in no way, shape, or form does it have anything to do with your profit and loss, insurance, or anything else. It's simply a deposit. And this is where too many people get lost. They either think they're buying insurance, so they can't lose more than that, or that they're using it as a premium, which is a partial payment, or lastly, that it is that's the maximum they think they can lose. Okay. So therefore, please remember, it's simply a deposit. Now, leverage is expressed in a ratio and is based on the margin requirements imposed by your broker. Now, to get leverage or margin, or to get margin from your broker or to get leverage, there is no credit check. It's not like applying for a loan at the bank. It's not like for deposits, applying for a credit card. If you have an account and your broker offers leverage, you're entitled to the same leverage as the guy down the street is, or the guy who's got $1 million in the account, as much as the guy who has very bad credit and is unemployed. Okay, it is a standard situation offered by the broker to his traders based on the asset in which you are trading. Now, for example, if your broker requires you to maintain a minimum 2% margin in your account, this means that you must have at least 2% of the total value of an intended trade available as cash in your account before you can proceed with the order. Okay. Now, it is not based on your account. There's no credit history. There's no anything. You don't get a 2% margin on all the cash in your account. Each trade has its own margin based on the margin that's available that day and how volatile the markets are. And if you're buying a stock, you're buying a CFD, you're trading futures. Each one is different, but you must have the money in your account to cover the margin. So expressed as a ratio, 2% margin is equivalent to 50-to-1 leverage. In other words, 1 divided by 50 is equal to 0.02 or 2%. So you can see on my table here, or my little charts here when they pop up, okay, it's a very simple thing. If 50-to-1 leverage, with 1 to 50 leverage, every dollar in your margin account controls $50 of trading. In your 1-to-1, every dollar gives you $1. If you're 100-to-1, okay, it is $1 to every 100. But again, it is not credit. Okay. So a 100-to-1 leverage has a margin of 1%. 50-to-1 leverage has a margin of 2%. So let's start out with a standard $1,000. If you wanted to trade stocks that were worth $1,000 at 100-to-1 leverage, you would have to put down 1%. What is 1% of 1,000? If you had 50 to 1 leverage, 2%. 40 to 1 leverage, 2.5. 10 to 1 leverage, 10%. So if it was $10,000, 100 to 1, you would be putting down what? $10. If it was 10 to 1 for a $1,000 trade, you would be putting down 10% or $100. As a trader, it's important to understand both the benefits and the pitfalls of leverage. Using a ratio of 50 to 1 as an example, which will most likely be the leverage through most of your home countries for CFDs, okay, it is possible to enter into a trade for up to $50 for every dollar in your account. Or if you're in euros, 50 euros for every euro you have in your account. If you're in pounds, 50 pounds for every 1 pound you have in your account. This is where margin-based trading can be a powerful tool. With as little as $1,000 of margin available in your account, you could trade up to $50,000 at a 50 to 1 leverage. Okay, so that's a lot of investment. You're using your $1,000 in your account, but you're tying up $50,000 of an asset. Okay. Now, you understand it's a deposit. If that asset goes down more than the $1,000, you still have the $1,000 plus the difference, because all this was a deposit. This means that while you're only committing $1,000 to the trade, you have a potential to earn profits of the equivalent of a $50,000 trade. Of course, in addition to earning the potential of $50,000, you also face the risk of losing funds based on the $50,000 trade, and these losses can add up quickly. Traders suffering a loss without sufficient margins remaining in their account run the risk of triggering what's called a margin closeout. That means your broker will close out your trade at that loss. Leverage is the ability to use something small to control something big. Specific to Forex trading, it means that you can have a small amount of capital in your account controlling a large amount of the market. Now, again, if we're using just a simple 50 to 1 leverage, means you have $1,000 in your account and you're tying up $50,000 worth of something. Just think a while back when it was 400 to 1, you were tying up 400,000. But when you think about currencies, when you hear that the euro tumbled today, the euro just tumbled pips. If it moved 25 pips, it's a big move for today, but that's 4 decimals over to the right. So that means the euro might have fallen from $1.08.50 to $1.08.25. Well, if you only have $1,000 in your account, you had $1,000 worth of euros, that whole trade that whole day made you a couple dollars. And by the time you covered the spread and by the time you covered your costs, you ended up with making nothing for the day. Whereas if you had leveraged it up to $50,000 in trading, you wouldn't get rich overnight, but you might have made yourself $500. Okay. Then stock traders will call this trading on margin. In Forex trading, there is no interest charge on the margin used, and it does not matter what kind of trader you are or what kind of credit you have. If you have an account, the broker offers margin, you can trade on it. The obvious advantage of using leverage is that you can make a considerable amount of money with only a limited amount of capital. The problem is that you can also lose a considerable amount of money trading with leverage. It all depends on how wisely you use it and how conservative your risk management is. So investors and traders use leverage to magnify their exposure to various markets. This allows them to free up their capital Hold on one second, please. This allows them to free up their capital to commit to other investments, thus spreading a set amount of capital much farther than would be possible by buying the physical assets. You can use leverage on most markets, including shares, Forex, commodities, indices, bonds, ETFs, and more. Forex is essentially, or especially, highly leveraged market, with some brokers offering as much as 400 to 1 and upwards. Naturally, there are risks involved with such great leverage, and you should take care to fully understand the risk involved. Firms also use leverage in the same way, so don't think that this is only something that they snooker in retail traders. It's not a scam. It's not anything. It's just giving you the ability to use more than you have. It's how wisely you use it, because hedge funds also use it. Banks also use it. Individuals with million-dollar accounts also use it because they can magnify their gains. A common corporate strategy is to use debt to finance operations. This is done because businesses feel they will make return on these investments above the cost of the interest they need to pay on their debt. Again, so leverage is not a bad thing. It is misuse of leverage that is the bad thing. And thinking that every time you trade, you need to use the maximum amount of leverage. It is all about having a money management, risk management program or strategy that you use so you don't overindulge yourself in risky trades that have high losses, that have the potential for high losses with smaller gains, that you end up losing your account and you're out of the market. I mean, it's not, the problem is it's not part of a get-rich-quick scheme. It's part of a very careful, very well-developed risk management, money management plan. Leverage makes a rather boring market incredibly exciting. Unfortunately, when your money is on the line, exciting is not always good. But that is what leverage has brought to Forex. Without leverage, traders would be surprised to see a 10% move in their accounts in 1 year. However, a trader using too much leverage can easily see 10% move into their accounts and in 1 day. While typical amounts of leverage tends to be too high, I trade with 5 times leverage. That's all that I use. I'm never going to put my account out there. I'm never going to risk my money. I'm more concerned with small gains with the smallest risk possible. It's important for you to know that much of the volatility you experience when trading is due more to the leverage on your trade than the move of the underlying asset. Because remember, a small move magnified thousands of times over gets to be a very large move. So again, if you wanted to trade, if you're trading 1-to-1 margin, which is equal, leverage and margin are the same, if you traded 100,000, you'd have to have 100,000. But if you were trading 400 to 1, to make that $100,000 trade, you'd only have to have $250. Okay, that's a lot. That means if you got $1,000 in your account, you could be tying up $400,000 worth of a currency. Okay. Now, for the most part, professional traders trade with very low leverage. Keeping your leverage lower protects your capital when you make trading mistakes and keeps your returns more consistent. Many professionals will use leverage amounts of like 10 to 1 or 20 to 1. It's possible to trade with the type of leverage regardless of what your broker offers you. You just have to deposit more money and make fewer trades. No matter what style, always remember, just because the leverage is there doesn't mean you need to use it. Now, in general, the less leverage you use, the better. It takes the experience to know when to use leverage and when not to. Staying cautious will keep you in the game for the long run. In Forex, investors use leverage to profit from the fluctuation in exchange rates between 2 different countries. The leverage that is achievable in the Forex market is one of the highest that investors can obtain. Leverage is a loan that is provided to an investor by the broker that is handling his or her Forex account. When an investor decides to invest in the Forex market, he or she must first open a margin account with the broker. Usually the amount of leverage provided is either 50 to 1, 100 to 1, or 200 to 1, depending on the broker and the size of the position the investor is trading. Standard trading is done on 100,000 units of currency. So for a trade this size, the leverage provided is usually 50 or 100 to 1. Leverage of 200 to 1 is usually used for positions of $50,000 or less. To trade $100,000 of currency with a margin of 1%, an investor will only have to deposit $1,000 into his or her margin account. The leverage provided on the trade is like 100 to 1. Leverage of this size is significantly larger than the 2 to 1 leverage commonly provided on equities or the 15 to 1 leverage provided on the futures market. Although 100 to 1 leverage may seem extremely risky, the risk is significantly less when you consider that currency prices usually change by less than 1% during total intraday trading. If currency fluctuated as much as equities, brokers would not be able to provide as much leverage because the stock moves very, very little. Yes, if there's a big day going on for Apple, it can move a lot. Okay, just like gold moves a lot, but gold's expensive. Percentage-wise, it's very, very small. Currencies, again, move in what's called a pip. It's a thousandth of a point. Okay. So when you see that the euro moved 25 pips today, that's a little tiny, insignificant move. And if you haven't leveraged up your trading, then it's just a small little nothing. But that's one of the reasons you can get such high leverage. Although the ability to earn significant profits by using leverage is substantial, leverage can also work against investors. For example, if the currency underlying one of your trades moves in the opposite direction of what you believe would happen, leverage will greatly amplify the potential losses. To avoid such a catastrophe, Forex traders usually implement a strict trading style that includes the use of stop losses and limit orders. Now, if you don't know what a stop loss or limit orders, you shouldn't be in the Forex markets. And if you don't know how to use proper risk management, money management, you shouldn't be in any of the markets. Using leverage can have extreme effects in your accounts if it's not used properly. Trading larger lot sizes through leverage can ratchet up your gains, but ultimately can lead to larger losses if your trades move against you. And I keep harping on this because this is the whole thing about leverage and margin, is using it correctly when the time is correct. I cannot tell you how many times I hear traders telling me the same story. Okay, well, I was sure the euro was going to go up, so I went in or used my whole account. The euro went down. I lost my whole account. Why? You didn't use, you just magnified everything you had and gave it all up in one trade. Okay, it is addictive. It is misleading. It's not misleading. It is no different than you hear all the sob stories of, I got a credit card in the mail today and they gave me a $10,000 limit, and you went and spent the next month on vacation, spending sprees and everything else, not thinking that starting a month after you have no more credit on your credit card and you're going to have to start paying it back. And how are you going to start paying it? Okay. When you're in debt $10,000. Okay. If you use your credit wisely and carefully and think about paying it back at all times and what your exposure is, you will find that you'll get better credit, you won't get in debt, and you'll steadily improve all of your ratings. Okay. This is the same thing with leverage. As your trading improves, or when after lots of experience that certain times trading opportunities present themselves, and it allows you to capitalize on that trading. And just because you made profit doesn't mean you should keep on using that 100 to 1. Go back to 0. Go back to 10 to 1. Go back to 5 to 1. Don't let yourself get sucked in there. Only when you have that one trade that comes in at, all of your trading strategy you built and worked for, all rings and says, trade me, trade me, trade me. Not the one, oh, look, I'm going to guess at that. I'm going to guess at that. Okay. So remember, you can still make the same trades with smaller risk and smaller loss. Leverage is there as a tool, and it's a great tool for you to use when you can properly apply it. So when you have that chance, when something tells you that Apple is going to go up, Okay, you know something, you've done some calculations, or Apple has dropped, something bad happened in the markets, and all the technology shares tumbled. Well, you could grab up 10,000 shares of Apple at a low price because you know it's going to go back to its normal price level next week, or something happens that gold skyrockets, Trump sends some more missiles of gold skyrockets. You can buy gold, sell gold at the top, and you want to get in that gold when it's all really high. For instance, the last time I used high margin was when Russia invaded Ukraine over the weekend, because you knew oil was going to go through the ceiling that next week. So you wanted to crank up and get in as much trading as possible for the highest you could to take advantage of. But the next week I wasn't back in oil at high leverage. But when it offers you an opportunity, you need to take it. But that's a very rare chance. Now, like in Forex trading, leverage is a position involving putting down collateral, known as margin, to take on a position that is larger in value. Currency pairs are usually traded in lots of 100,000 units. Okay. Or you can get a mini lot at 10,000 units. This means that a trader must buy, and this is the thing in the currency market, you must buy $100,000 of the base currency. So if you want to trade the euro US dollar, you have to buy the $100,000 worth. So if you don't have enough cash in your account, you're going to have to use leverage and margin. But it doesn't mean you have to buy 200,000 base pair, or you can buy a mini lot while selling the equivalent number of the counter currency as dictated in the currency rate exchange. So when you ask price for the euro US dollar is 125, 100,000 euros are bought while $125,000 are sold. That's the technical part, but you're actually just trading the euro US dollar. For a standard contract, one lot in which the US dollar is a counter currency, 1 pip will equal $10 or $1 in mini lot size. So 1 pip is $10, not per euro you have, is per contract. So if you had 100,000 euros, which is one lot, and it moved 1 pip, the difference is $10. Okay. Now, if you're covering a spread, that barely covers the spread. If you're trading in mini lots, you only made $1. So therefore, you need to use leverage. For all our pairs except exact pip values are slightly different, and the range can be from $8 to $20. It all depends on what the asset's trading for. Let's take a trader with $2,000 in his account, which is his total balance or equity. Our trader buys one lot of the USD JPY, Japanese yen, at 97.50, and the Japanese yen is the only thing that trades at these ridiculous numbers. Okay. One US dollar buys 97.50 Japanese yen with a 100 to 1 maximum leverage. The trader utilizes margin of is $1,000. He or she has $1,000 of floating equity or unused margin in his account. If the trader was to close the position right away, and the utilized margin, the $1,000 collateral, would be returned back to the total equity, and he or she would still have $2,000 in their account minus some transaction costs, because the spread is usually 2 to 5 pips. Now let's say the same trader keeps his one lot buy position open. If the position moves in the trader's favor, the gains are added to the floating equity in the trader's account. Likewise, if the position goes against the trader, the losses are subtracted from the account's floating equity. So it's moving up and down. Your equity position is moving up and down continuously in your equity account. These floating gains or losses are realized when the trader closes his position. If the price moves in 100 pips in the trader's favor, the exchange rate moves upward from 97.50 to 98.50, then the trader would make a $1,000 gain. In other words, 10 per pips times 100 pips. So you made $1,000 on risking. How much did you risk? The trader has effectively made a 50% return on his or her $2,000 account. But they only had tied up $1,000 of margin. So they effectively made a 1,000% gain. You made $1,000, you only put up $1,000. But conversely, if the direction of the market had gone 100 pips against a trader, his or her position would have been closed due to a margin call with the floating equity and reached one that was $0. The margin call comes as the account's total equity drops below the $1,000 margin. Okay. Since many small traders are inexperienced in trading Forex, they tend to expose their accounts to significantly higher levels of effective leverage. As a result, this increase in leverage can magnify losses in trading accounts. Emotionally spent traders then either give up on Forex or choose to compound the issue by continuing to trade in relatively high amounts of effective leverage trying to cover their losses. This becomes a vicious cycle that damages the enthusiasm which attracts traders to Forex. No matter how good or bad your strategy is, your decision or non-decision in this case about effective leverage has direct and powerful effects on the outcomes of your trading. Last year, we published some test results for over time of the same strategy with different leverages. Okay. The lower leverage you used, it seemed eventually you made more profit because the traders were more cautious and had smaller losses on their bad moving trades. Now, when we move over to CFDs, CFDs are already built in with leverage. So a contract for difference is a popular form of derivative trading. CFD trading enables you to speculate on rising and falling prices of fast-moving global financial markets or instruments, such as shares, indices, commodity currencies, and treasuries. Some of the benefits of CFD trading are that you can trade on margin and you can go short, sell, or if you think the price can go down, or go long if you think the prices will rise. CFDs are a leveraged product, which means that you only need to deposit a small percentage of the full value of the trade in order to open a position. This again is called trading on margin. Now, because the CFD is a broker-generated product, you have to be very careful because the brokers are pushing out there their high leverage products to get you to trade larger because they make their money on the spreads and the volume. They're not trading against you. They're not the other side of your trade, so they're not hoping you lose. They make their money on volume. Okay. Now, most brokers offer several different CFD sizes on a particular asset, but you have to find them because if you want to go in and trade gold on a CFD, they've already factored in the 400 to 1 leverage or whatever the maximum leverage is. Okay. You need to find the other contracts that they're offering with smaller leverage. Okay. Investors are attracted to CFDs because of the leverage opportunities they offer, the low initial capital required to commence trading, and the perceived ease in trading. However, most investors are oblivious to the risks of CFDs and lack a real understanding about the impact of leveraging and how it can devastate them. And this misunderstanding is at the center of the CFD risk. If you start trading and your whole trading philosophy and strategies limiting risk at all times, forget looking at profits. Forget getting rich quick. Look at how can I get involved in the lowest risk trade so that your profits can compound over time. Okay. Lowering your risk is the most important part. It's a pity, but some traders are attracted by exaggerated claims of the fortune that can be made trading contracts for different CFDs and never learn how to use their accounts safely before they lose all their money. These are the friends who will tell you overall that they just break even or just slightly profitable over time. While many other large returns on individual trades, these are counterbalanced by losses on others, and CFDs are unlikely to meet the investment needs and objectives of all retail traders. CFDs can be defined as a high-risk derivative instrument typically used by sophisticated traders to take geared short-term positions in volatile markets. Now, don't misunderstand me. Again, I keep emphasizing the negatives because it's very important for you to understand this leverage is a great tool if you use it properly. Okay. And you have to understand. You can't blame your broker. You can't blame your online platform. You can only blame yourself if you lose your account because you misapplied or understood leverage, or you got in the markets because you got greedy. Okay. However, it is important to note that even though a smaller initial deposit need to open a trade, you'll still be exposed to the price movement of the share CFD for the full nominal worth of the position. Perhaps the most familiar comparison that can be drawn is with buying a house with a mortgage. Most people understand that they can buy a house by putting down 10 or 20% and borrowing the rest of the mortgage for years to pay back. Until the housing bubble of recent years, this has been considered an extremely safe and profitable way of using your money. You can buy a house worth $200,000 by paying down $20,000 as a deposit, making payments of $1,000 per month. When the value of the house rose by 10%, you made $20,000 on your initial investment of $20,000. The housing bubble represents what can happen when you trade CFDs. Leverage is a good thing if you are making good trades, but a terrible thing if you trade badly and do not know about money management. Newcomers to CFD trading sometimes take the same view as buyers of real estate used to and believe that prices would never go down. As prices go down or as CFDs go down, you can end up owing more than you have available. With houses, it's known as being underwater or upside down on your mortgage. With CFDs, you get wiped out. That's just the simplest way to understand how leverage can work against you as well as for you. If you wish to keep your risk to a bare minimum, you can trade CFDs with no leverage and treat your account like a share dealing account. So you can make smaller investments, or you need a larger account. You'll make less magnified, but you'll make the same profit. If you traded Apple to go up and Apple went up, you would still make the same profit. You just would have it magnified less. Okay. So it's very important to understand you're in control. It's only a tool, and it's for you. CFDs and financial spread trading carry high levels or risk to your capital, and you should only deal with money you can afford to lose. The value of investments can fall as well as rise, and you may lose significantly more than your initial margin payment. We do not recommend that trading in these products is suitable for all types of investors. We recommend that you consult an independent financial advisor if you're uncertain whether it's right for you. Okay. And the first step in trading is to develop a money management, risk management scenario. Put it on paper, write it out, understand what, whether you figure out a trade is a good trade by doing all your technical analysis, your fundamental analysis, whether you have some secret weapons, whether you have some, indicators that somebody told you how to use. Okay, all that's right. So you're now going to make a good trade. Money management, risk management have nothing to do with whether you make a good trade or a bad trade. It's how do you control your risk and how do you keep your emotion out of the market? How do you cover the swings of the market? And how do you compare when Donald Trump sends those satellites, those missiles up to Syria, so the dollar goes in a mad panic, the Japanese yen goes up, the dollar goes down, when every reason should have told you the night before you went to bed that the Japanese yen should be going down. Or oil soars because of this. Okay. You don't know, but the thing is when you're trading on margin, it magnifies your potential losses. Okay. And it is a tool to be used correctly. When you use it correctly, it can be used very successfully. But remember what Warren Buffett said, it's addictive. Okay? And once you've bragged to your wife, you made so much money in the market today, it's hard to go back and tell her, I made less today because I used less leverage. Okay? Don't let your emotions get involved. Have strong money management, risk management skills, and use leverage gently. And you can find that this tool can help you in the long run be very successful. Thank you very much for joining us tonight. Have a great weekend, and we'll talk to you again real soon. Good night now.